Welcome back to our second presentation for Chapter 5, Financial Ratios and Ratio Analysis. And in this presentation, try to stay awake now, we will go through the many profitability ratios, the leverage ratios, the activity ratios, what other ratios there are. There's lots of ratios to go through. And once you've done a few of them, they're pretty straightforward. Which is why in the assignment, we only ask you to do 12 out of the over 2 dozen. So what you would benefit from, in my humble opinion, is to print out the formula sheets. Here's the formula sheet for the financial ratios, and it has all of them here. Yeah, the profitability, we're going to go through the profitability, liquidity, activity, and leverage ratios. And we'll move fairly quickly. My apologies if I'm going too fast to slow it down. And some of you are going to say, well, you're going too slow, Piano. You're going to also need the balance sheet and the income statement. I would print those out or have them on your screen or whatever at your disposal. I don't think we're not going to be using the cash flow today, but have that when you're doing your analysis. Make sure you do the cash flow per share. That was in the previous presentation. Okay, so let's get started on slide number 21 with the profitability ratios. These financial ratios measure a firm's returns by relating profits to sales, profits to assets, profits to equity. And the return on assets and return on equity are two measures that are looked at quite often. And then there's a third one that is lumped into the mix called return on invested capital that's popular with people such as Warren Buffett. So let's take a look at the first one, the net profit margin, also called the after-tax profit margin. The net profit margin is the rate of profit being earned from earnings after expenses and taxes. So we take the net income, remember we called that the bottom line, and divide it by the total revenue, the top line. And of course, the higher the better, and it varies greatly from industry to industry. So if you look at the formula sheet, it'll say, oh, you got to go to the income statement. But you can figure that out once you peruse the balance sheet and the income statement. Where's the net income? Where's the total revenue? Well, as we said, the net income is the bottom line. Here it is, 261,160. The top line number, the total revenue, is 6,400. And some people's calculators might not be able to do all these, so you might need to find a scientific calculator or use your computer or something like that. But the numbers with Sprouts Family Farmers Market are enough for a 99-cent calculator. So we take the 261,160, the bottom line, the net profit, the net income, and divide that by the total revenue. And what I get is, what did I get? 4.08%. Is that good? Well, I don't know. I mean, it's better than negative, right? At least they're making money. But what we need to do is compare it to their competitors. Exactly. We have to compare it to other grocery stores. Sprouts Farmers Market is sort of a niche, higher end. The closest competitor would be Whole Foods, but Whole Foods is now owned by Amazon. You might want to compare it to the company that owns Trader Joe's, which is Aldi, which is actually based in Germany. So without knowing how their competitors are doing, is 4.08% good? We don't know. We just don't know. Now, if you were to go to Yahoo, for example, and look at their finance page, you go to statistics, and they will say that, oh no, the net profit margin is actually 3.86. What's the difference here? You will see TTM next to that number. And what does TTM stand for? Trailing 12 months. Yes, we're looking at the net profit margin from December of 2022. Whereas, as we said in the previous presentation, many people will pull up the quarterly reports, the quarterly financial statements, and go back 12 months from the last quarter. And that's why it's a little different, not much different, 4.08 versus 3.86. Make sense? Okay, that was their net profit margin. The next one takes a look at the gross profit and divides that by the total revenue. So if you remember our income statement, we had our total revenue and then we had our gross profit. So in this case, we had to pay over $4 billion to sell that materials, those goods, cost of goods sold, cost of revenue. And we have 2.382. We divide that by the total revenue. Let's go back to the thing here. And we get 37.22 for a gross margin. Well, is that good? Is that bad? Well, again, we got to look at other the companies, competitors, but that's about right, folks. If you think about a grocery store, when you walk in, depends on what it is that they're selling, but they're marking stuff up about 30%. Yeah, 30, maybe 40%. Some things not very much at all. Stuff that they sell quite often, like milk and diapers, they don't mark up as much just because they sell it so often. And other things that they don't sell as much, they might mark up a whole lot more. But that makes sense. That's typical, right? Because, yeah, they got to stay in business, right? They can't sell it at cost or they wouldn't be able to stay in business. So again, we'd have to take a look at their competitors and see if that's quite good. The next one, again, if I'm going too quickly, just stop it, pause it, do the calculation, make sure I got it right because, I make mistakes, so I make a lot of mistakes. Slide number 24, the operating margin. Same idea. You take, instead of the net income, instead of the gross profit, we take the operating income and divide that by the total revenue. So we go back to our income statement and we go down one more category. There was the top line number, the total revenue, then the gross profit, and now the operating income, 352,580. And we divide that by that same total revenue. And what do we get? 5.51%. So you guessed it, the higher the better. It varies greatly from industry to industry. So when we are looking at a specific company, we always need to look at its competitors within the industry. When we find a company that is atypical of its competitors in the industry, it is a signal that we have more investigative work to do. It might be a competitive advantage or disadvantage. You see? But just that one number doesn't signify, oh, yeah, we should buy the company, oh, we should sell the company, whatever. It's just one more flavor that we throw into our stew that tells us more about the company itself. And once you've done, as we said, once you've done a few of these, they're pretty simple to do. Next one, slide number 25, is return on assets. Now, this is a measure of how profitable a company is relative to its total assets. So the net income comes from the income statement, but where does the total assets come from? Right, the balance sheet. Return on assets looks at the amount of resources a company needs to support operations. It reveals how effective the company is in generating profits from the assets that it has available to it. And of course, the higher the better. But again, we got to look at their competitors. So the net income, remember, that's the bottom line. We go up to the income statement. Remember, it's 261,160. But now, to get the total assets, we need the balance sheet. Now, don't be confused. Total current assets just are the assets that are going to be consumed within a year. Make sure you go to the total assets. So that's 3,466,000,000 or three. Just write the whole number down. 3,446,000. So we're going to divide the net income, that 261, 160 by the 34466, and we get, what did I get? 7.53%. Now, if you go to Yahoo, it's going to say 7.81% because they're using trailing 12 months. But that's, again, something we have to compare to the competitors. It sounds good, 7.5%, but maybe other company is doing a whole lot better. Maybe it's doing a whole lot worse. We need to create that stew of numbers to compare against other companies in the same industry. Along with return on assets, a very popular measure is return on equity. This is a measure of the overall profitability of a company in relation to the shareholders' equity. In other words, how much of the company do we own? Return on assets looks at all the assets regardless of the debt. Return on equity takes into account how much liabilities, how much debt the company has. Because return on equity uses stockholders' equity instead of total assets for the denominator, return on equity is sensitive to the amount of debt a company is carrying. Specifically, if a company carries a great amount of debt, return on equity will be larger than return on assets, sometimes much larger. And what you'll hear people say is, you are using other people's money to make your money. You know, some investors view this positively because, hey, you know, we didn't have to earn that money, we borrowed it. Others are worried about the possible negative consequences of too much debt. I'm one of them. I don't like debt. But obviously, you know, you got to get from point A to point B, and if you don't have the cash, you got to borrow it. And if it was borrowed to create, you know, wealth, to create productivity and earn more cash for the company, then great. But other than that, that can get you in a whole lot of trouble. So if we remember, let's go back to the balance sheet. Sprouts Farmers Market. I keep wanting to call it Sprouts Family Market. Sprouts Farmers Market had loaded up on a ton of debt, right? So, oh my goodness, what is the total liabilities? Over $2 billion. So their equity is 1.05 million. 1.05 million. So out of the $3.5 billion of assets, they only own 1 billion of them. So what we're going to find is the return on equity is quite larger. We take the net income, that 261, 160, divided by the $1.05 billion, and we get 24.87. Over 3 times, almost 4 times as much as the return on assets, because we've borrowed, or at least Sprouts Farmers Market has borrowed a whole lot of money now. So the return on equity looks very high. We compare it to other companies, other competitors, and we might see that their return on equity is a lot less. Why? Because they haven't loaded up on debt. So that might be actually a good thing to have a lower number, depending on how much debt they have and what they're doing with that debt. Are they using it to create more products, more sales, more earnings, or did they do it just because the money was cheap, turn around and bought more shares for their stock to promote the stock price, which is what happened after the tax cut of 2017. Many companies just borrowed money to turn around and buy back their stock. I don't think that's very smart, but hey, I'm a community college instructor, not making millions of dollars as a CEO, so what can I say? Slide number 27. Now, another one that goes with return on equity and return on assets is called return on invested capital. There are a few different ways of calculating this. We're going to use the easiest one, this most simplistic one. By using long-term debt and stockholders' equity, the return on invested capital measures how well a company is managing all the capital that the company needs to earn its profits. Capital is a fancy word for resources. So you take the net income, but you subtract out the dividends because you paid those out. Then you take the long-term debt and add that to the total stockholders' equity. And as I said, there's a couple other versions which are a little bit more sophisticated, but it's the same idea. It's a more sophisticated version of return on assets and return on equity. And I might add that it's one of the very popular measures that Warren Buffett, very famed investor, uses. So in this case, I won't bore you with the details, but if you do it, take the net income minus the dividends. Where would you find the dividends? Income statement. Long-term debt and the total stockholders' equity, balance sheet. I get 10.66%, which if a company is really earning 10% on its assets that it uses to earn the profits, in my humble opinion, that's pretty darn good, 10%. But we have to look, right, you know what I'm going to say. We have to look at the competitors. I'm starting to sound like a broken record, right? So those were the profitability ratios. Play with those. The next group are the liquidity ratios, very popular. And there are three, although this one, the net working capital, is not really a ratio, and so we have to have one that's sort of an oddball, right? These liquidity ratios are concerned with a firm's ability to meet its day-to-day operating expenses and satisfy its short-term obligations as they become due. The current ratio takes the current assets and current liabilities. The quick ratio, or also called the acid test ratio, what a great name, uses the same current assets to current liabilities, but it pulls out the inventory. It says, the inventory might not be useful anymore. It might be obsolete. It might have gone bad. We don't know. So it's the same idea, but it pulls out the inventory, as we'll see. Now, the net working capital is really the current ratio as an absolute dollar amount. So we're going to see that as we go through these three. All three use the balance sheet. So have the balance sheet ready at the ready. So the current ratio, as we said, is one of the more popular financial ratios. And it's a good indicator of how stable a company is. Anything over 1 is normally considered acceptable. If your current assets equal or exceed your current liabilities, you should be able to satisfy your short-term obligations without any problem. Obviously, the greater the number, the better. So, in other words, are you going to get hauled off the bankruptcy court if you can't meet your current liabilities? Some companies, the tech companies, with very little debt and cash coming out of their ears, have current ratios that are well above 1, 60, 100. And it finally turned out, this was 20 years ago, when Microsoft had so much money they didn't know what to do with it. How many times can they rewrite Word? Every time they do it, they make it worse, or Windows. And so their current ratio, I forget what it was, but it was I think it was like 120 or something. And they finally said, okay, let's pay out some dividends. And since then, they've been a pretty darn good dividend payer, along with Apple. Who else? Some of the other tech companies that have said, okay, let's pay some of this money out to the shareholders. So let's go to the balance sheet, which is right here. We take the total current assets, $673,800,000, and we divide them by the current liabilities of $522,380,000, and we get 1.290. And as we said, anything above 1 is considered acceptable. So is Sprouts Farmers Market going to be hauled off to bankruptcy court anytime soon? No. They got plenty of cash on hand. Now, the next category, as we said, is a bit of an oddball. It's not a ratio. It's the current ratio, but in absolute dollar terms. You take the current assets and you subtract the current liabilities. In other words, how many dollars do we have of current assets above and beyond the current liabilities? And of course, if If the current assets is greater than 1, it'll be a positive number because the current assets will be greater than the current liabilities. If it's less than 1, it'll be negative. And if they're the same, it'll be 0. And of course, the higher the net working capital, the better, because it means you got plenty of cash on hand. It's not that popular, but it is also often discussed when we're discussing the current ratio and any other liquidity ratios. Well, how much cash do they actually have on hand above and beyond their current liabilities? Well, again, if we go back to the balance sheet, we take the current assets of $673,800, subtract $522,380, and we get $151 million. So Sprouts Farmers Market is very flush with cash. Thank you very much. That was the one oddball. It's not a ratio. It's a specific absolute number of dollars. Now, the next liquidity ratio is the more stringent version of the current ratio. It's called the acid test ratio. What a great name. Or the quick ratio. Now, it's very similar to the current ratio, but what they do is they pull out the inventory. I see this formula over and over again, but really, folks, all you got to do is take current assets and subtract inventory, which I have on the bottom, which I think is just a whole lot easier. So why go to add the cash and the accounts receivable and the short-term investments and other current assets? Just take the current assets that we used in the previous 2 slides and pull out the inventory. Now, why would you do that? Well, this measures the ability of the company to meet its short-term obligations even if its current inventory becomes obsolete or undesirable, and hence difficult or maybe impossible to be turned into cash. This is very important, for example, with computer companies. In fact, it was Dell that started this back in the 80s. We're not going to have any inventory. We'll develop these models to be sold to the world, but we won't build them until somebody orders them. Because why would you want to have 6 months inventory of computers when you know 6 months later the darn things are not worth anything? Nobody wants them. They want the newest, latest computer. Now, is Sprouts Farmers Market going to have a problem with that? Well, obviously the fresh fruit and vegetables are going to spoil, but all the other stuff is fine. It's going to last. The diapers aren't going anywhere, and all the other food stuffs can, the canned goods and stuff can last for many months at a time. So Sprouts Farmers Market is not going to have this problem. But let's do the calculation anyway. So let's go to the balance sheet. We're going to take the $673,800 of current assets and subtract out the inventory. You see that? You see what that? Subtract that puppy out, and then divide it by the current assets. It's like $300 million of inventory. And so when we do that, we're going to wind up with, what did I get here? 0.695 or 70%. So whereas the other one was over 1, the current ratio was 1.29, 1.3. After taking out the inventory, it falls to less than 1, which is sometimes a bit of a red flag, but in the case of Sprouts Farmers Market, no, it's not a problem, right? It's not going to be a problem. And of course, they're not worried, obviously. So that's the acid test ratio for the Sprouts Farmers Market. Now, if it were a computer company, we'd be a little worried. Okay, the next group are called the activity ratios. My apologies if I'm going too quickly. Please just slow down the presentation for yourself, or maybe speed it up because you're saying, well, this stuff, it's a little dry, as we said. All an accountant's spouse has to do is, dear, tell me about your day at work. Anyway, activity ratios, sometimes called the efficiency ratios, measure how effective a company is managing its assets. So we have accounts receivable turnover, inventory turnover, and total asset turnover. They use data from the balance sheet and the income statement. So activity ratios measures a firm's ability to convert different accounts within their balance sheets into cash or sales. Companies will try to turn their production into cash or sales as fast as possible because this will generally lead to higher revenues. And that makes sense. In other words, you don't want stuff sitting around not being sold. You want it to get out the door because that's how you make money. And so let's take a look at the first, accounts receivable. Accounts receivable is money that is owed to us. And if you've taken accounting, you know what this is. But it's not that difficult to figure out. It's basically money that hasn't come in the door yet, but it should be coming in very soon. The higher the number, the better. It indicates the return a company is getting from its investment in accounts receivables. By maintaining accounts receivables, firms are indirectly extending interest-free loans to their clients. A high ratio implies that the company operates either on a cash basis, as like Farmers Sprouts does, or its extension of credit and collection of accounts receivable is inefficient. A low ratio implies that the company should is efficient. A low ratio implies that the company should reassess its credit policies in order to ensure the timely collection of imparted credit not earning interest for the firm. In other words, we want people to pay their debts. If it is low, it may just be how the industry operates. One example of this is the Defense Department, defense industry. Uncle Sam will pay his debts. He will pay for that $12 billion aircraft carrier or however much it costs now. But he just takes his time. And I was never in the military, but I worked for contractors for the military. And the military was prodded by the Congress, this was back in the late 70s or in the 80s, to bring in more competition, bring in more smaller companies for their procurement. And so small companies started bidding on the contracts, and they would produce the goods or services. And then they'd say, okay, pay us. And the Defense Department would say, don't worry, we'll get around to it. And and the companies, wait a minute, we don't have that kind of, the big companies have that kind of resources. They can wait for their $12 billion check. The smaller companies were screaming and hollering saying, you can't do this to us. And so the Defense Department, my understanding now, this was many years ago, folks, my understanding now is they pay their debts a whole lot quicker. So let's do this one very quickly. We know what the total revenue, that's the top line number. Remember that number? What is it? Whoops, 6.4 billion. And then we take a look at the accounts receivable, 34 million. Oh boy, we're going to see this is going to be a very big number. And exactly it is. You take the 6.4 billion divided by 34 million, 260, and you get 186. 186. So that means every couple of days the accounts receivable turns over. So Sprouts Farmers Market does not really worry about people having to pay their debts because most people just come in and pay right away. The next one is inventory turnover. Now, this is a very important number for many different types of companies because if you get stuck with some inventory that can't be sold, oh boy, could you be in big trouble. The higher the number, the better. We do the same thing. Total inventory, total revenue, but divided by inventory. The less time an item spends in inventory, the better the return the company is able to earn from funds tied up in inventory. As with all ratio, we must compare this against other industries, other competitors. A low turnover implies poor sales and therefore excess inventory. A high ratio implies either strong sales or ineffective inventory buying and maintenance. High inventory levels are unhealthy. Why? Because they represent an investment with a rate of return of 0. It doesn't do you any good until you sell the stuff. And it also opens up the company to trouble in the case of falling prices or obsolete products. And we've already mentioned the computer industry, which doesn't want any inventory. But think of it. You're a car dealership. You want plenty of cars on the lots to get people in the doors to look at cars. But you don't want plenty of cars on the lots because they're not making you any money. And you have to pay. You're paying for the darn things. But you haven't sold them yet. So that's the push me, pull you problem that car dealerships have. They want enough inventory to get people in the door to take a look at cars and buy, but they don't want too much. So the inventory turnover, it's the same idea. We're going to take that same inventory total revenue, 6.4 billion. In this case, the inventory was a little over 300 million. And what I get? 20. So what does that mean? About 20 times a year, Sprouts Farmers Market turns over their inventory. So you walk into a Sprouts Farmers Market, you walk into a Sprouts. I'm going to stop saying farmers. I'm going to just say Sprouts. And a couple of people who took the class from the other side of the country, they thought they didn't think it was a real company. I said, no, it's a real grocery store. Sprouts really is a grocery store. And so you walk into a Sprouts and you say, oh, okay, look at the inventory's here. No, it's always turning over. And if it turns over 20 times a year, that means about every 2.5 weeks or so, all the product that you see sitting in front of you has turned over. Now, some of it turns over every day, and some of it turns over every few weeks or months or so. Some of the stuff maybe doesn't turn over that much at all. But, it's food. It's got to turn over quickly. So they're turning stuff over every couple of weeks. And that's a good thing. That's the way it should be in a grocery store. Okay. Next one is the total asset turnover. This takes the total revenue, that top line number, and divides it by the assets. This measures the firm's efficiency at using assets to support sales and revenue. The higher the number, the better. Companies with low profit margins tend to have high asset turnover, and those with high profit margins tend to have low asset turnover. So you take the total revenue, what was that, 6.4 billion. Total assets was a little over 3 billion. You get 1.846 at 1.845 or something like that, almost 1.9, and 1.8. And is that large? Again, we got to look at the competitors to see how that plays out in the industry as a whole. Okay, we're in the home stretch. We're going to take a look at the leverage ratios, also called solvency ratios. And when you read eventually the Intelligent Investor, you will see the master, Benjamin Graham, at work as he looks at these, because he was very worried about companies disappearing, bankruptcy, and the like. So let's take a look at these. These are financial ratios that are used to measure the amount of debt being used to support operations and the ability of the firm to service its debt. And these might look familiar, a couple of these, because we did similar debt to equity ratios, debt to income ratios, debt payments to income ratios in the financial planning class and the principles of money management class. So debt to equity times interest earned, total debt to total assets, and then total debt to capitalization. Debt is often referred to as leverage. And you're going to hear this term often. Are they highly leveraged? The idea is that you are using other people's money to make money. You are using the borrowed money as a lever to increase your earnings. When one firm buys out another firm using borrowed money, it is often referred to as a leveraged buyout. The very famous case of Elon Musk buying Twitter, he borrowed a lot of that money. And so now he's got to pay it back. Now he could always sell a bunch of shares of his Tesla and pay it, but he'd rather not do that. So that's a leveraged buyout. So let's take a look at the debt to equity ratio. This is a measure of a company's financial leverage calculated by dividing the long-term debt by the shareholder's equity. It indicates what proportion of equity and debt the company is using to finance its assets. So we take that long-term debt and the total equity, total shareholders' equity. So let's go to it's on the balance sheet. Go to the balance sheet. What's the long-term debt? $1.4 billion. And we divide that by the shareholders' equity, the common stock, the shareholders' equity of $1.4 1.05 billion, and I get 133%, 1.33333333. Now, to me, this is a bad sign. This is not good. That means you have a whole lot more debt than you have in terms of equity. A higher debt-to-equity ratio generally means that a company has been aggressive in financing its growth with debt. This can result in lower earnings as a result of the additional interest expense and hence lower taxes. Sure, you get to write off the interest, but what happens if you can't make the payments? You're in bankruptcy court. Sometimes investors use total liabilities, and that would be even worse, instead of a long-term debt. For us risk-averse investors, the lower the better. Now, we're going to find that I am totally overemphasizing this because Sprouts can easily pay its debts, as we're going to say, easily pay the interest payments on this debt. We're going to see this in just a few slides, so stick with us. The next, here it is. This is the next slide. This is the one that Benjamin Graham was very, very interested in. This measures the ability of a company to meet its fixed interest payments. You take the earnings before interest and taxes, and you divide it by the interest expense. Now, these are on the income statement. Times interest earned is used to determine how frequently interest payments are earned by the company during a year. And obviously, the higher, the better. 3 or 4 is considered adequate. Where do you see Sprouts family market? Sprouts. We go to the earnings before interest and taxes of $360 million, and we see that their interest expense is $11 million. That means, if you do that calculation, you get 32.5. So that means there are 52 weeks in a year. That means every week and a half or less, every week and 2 or 3 days, they are making their entire debt payments for the entire year. That's if you or I were working for a week and a half and making our mortgage payments for the entire year, or our rent payments for the entire year. So that's why Sprouts is not worried about the amount of debt that they're holding. They're doing just fine, thank you very much. Piano, shut up. They're thinking, well, they probably don't know about me, but if they were to go through this and say, oh, did you know this guy used our company as their example, and he was really worried about our debt? They would say, he's a goofball. So yeah, Sprouts is in no danger of going into bankruptcy anytime soon. Slide number 39. Same idea. We're going to take this time the total liabilities and divide it by the total assets. The total debt to total assets includes both short-term debt and long-term debt. If it varies substantially from that first debt-to-equity ratio that we saw 2 slides ago, the company may be relying heavily on short-term debt. A heavy reliance on short-term debt can denote more risk. It doesn't have to, but think about it. A lot of people who are just getting started in business, often the banks won't touch them. They've tapped out their savings. They may go to friends and family. They wind up financing it using credit cards, short-term debt, which is very expensive and can get you in serious trouble. But again, we don't have to worry with the case of Sprouts. They have total debt. Let's go total liabilities. That's on the balance sheet. Total liabilities of $2.38 billion. Total assets of $3.466. And so their total debt to total assets is about 70%. 68.67 is what I get. So again, more than yours truly, humbly would like to see, but they ain't worried. The last one is a more sophisticated version of the total debt to total assets. It's total debt to capitalization. It's a measure of the total amount of outstanding company debt as a percentage of the firm's total capitalization. Again, capitalization is a fancy word for how much debt, how much equity you have. So they take the short-term and the long-term debt, and divide it by the short-term debt and the long-term debt and the shareholders' equity. Now, if you go through this calculations, we won't do it, but you can just plug in the numbers. Make sure you do the numerator first, then the denominator. You get 59.41%, which is a little less than the 68% we saw with total debt to total assets. But again, Sprouts is not worried about this this number of debt, amount of debt. As with other debt ratios, the higher the debt level, the more risk of insolvency. However, some industries with high rates of debt, such as utilities, also have more reliable earnings, right? So some companies, they need to borrow a ton of money, but because they're well established in the local or national economy or global economy, they are not worried about the revenue coming in the door disappearing. As always, we must compare our results with the competitors and the industry as a whole. So, I know it wasn't that exciting, dear students, but it's important. After we've done the exciting valuation models and read everything we can, the annual reports and all the articles we can find, we do the financial statements and ratio analysis, and that gives us a broader picture or more well-rounded picture of the company as a whole, and allows us to compare our potential investments with their competitors. And sometimes we find that, hey, the competitor looks even better. Well, dear students, we have done the heavy lifting with regard to stocks, chapters 3, 4, and 5. We want you to continually go back and study these 3 chapters, especially chapter 3 and especially chapter 4. Chapter 5, once you've done a few of these, you can figure it out. It's not that hard. Because now we're ready for a little silliness. Our next chapter, we will discuss market efficiency theory, or who can beat the market. Can anybody actually beat the market? Yeah, it turns out there are people who have done it over many decades. And then after that, there's even more silliness. But we are so proud of you. You are now official investment gurus. Study chapter 3, study chapter 4 over and over and over again, and be prepared for an entire lifetime of learning and honing your investment skills. We are so, so proud of you. See you in our next chapter, where we take a look at market efficiency theory and ask the question, who can beat the market?